Covenants are red flags in loans, warning signs basically, which tell the lender if the borrower may be experiencing financial difficulties. Now, if a covenant is breached, or basically if you break a covenant, then technically the lender has the right to call the loan to be repaid early. Now, in reality, the bank would try and work out what was going on before pulling the plug. You don't want to be seen as a so-called fair weather lender. Now, a typical covenant you'll find in a loan will be an interest coverage ratio, or like a debt service ratio. So if I lend to you, I want to know that not only can you repay the loan, but you can also service it as well. So I want to know that for every $10 of interest cost or expense, you can cover this several times over. Now, what you do here is you would look at the borrower's earnings before anything has been taken out for physical interest expense or tax charges or depreciation or amortization charges. And once you've looked at those earnings, look at the interest expense. So I want to make sure that I can see that your interest expense is being covered 3, 4, 5 times at least. So even if interest rates go up, you can still service the debt. Now, in some cases, the bank might insist that a borrower put some sort of interest rate hedging or protection in place. Leveraged loans are a good example of this, where the lender would typically require interest rate protection. Now, if you see the word leveraged, like in leveraged finance, leveraged loans, all it means is that you're borrowing a lot of debt, somebody else's money, to help you do the deal. So obviously it's very interest rate sensitive. Now, typical examples of leveraged debt would be things like project finance, infrastructure projects, it could be mergers and acquisitions, or a leveraged buyout where you're borrowing a lot of money to take over somebody else's company. So what I want to do is, if I'm the borrower, I want to look at where interest rates are and figure out what the market thinks rates are going to do. Now, in this forward LIBOR curve, what that shows us is where 3-month dollar LIBOR is today. Now, in this example, it's down at 1.3%. Now, if you follow the line up to the right, what this is doing is the market is saying this is where we think 3-month dollar interest rates are going to go. And so over the next 10 years, the market believes that rates will more than double to just under 3%. And here, in this case, it's about 2.8%. So what I want to do is figure out if that does happen, how will that affect my cash flows? Now, the client can, once they've figured out the financial impact of rates going up, can lock in their interest rates. They can swap their exposure from a floating rate exposure to a fixed rate exposure. Now, the fixed rate you'll be quoted by a bank is often the average, the weighted average when we take time into account, of where we think floating rates are going to be. In other words, if the market was perfect, then at the end of 10 years, whether you've paid fixed or floating should make no difference. And based on this yield curve, you've got a fixed rate there of 2.15%. So it doesn't matter actually what rates do, you're going to be locked into paying 2.15% for the next 10 years. If you think rates might go up, but probably not, and you don't actually want to lock it in, you can do what we call an interest rate cap. So if you pay me a premium up front, an amount of money up front which is not refundable, what I do is I will make a promise to you that as long as rates stay below, in this case 2.15%, lucky you, enjoy low rates, but if rates ever set above 2.15%, don't worry, I will deal with it. So in other words, let's say rates go to 2.5%. What happens there is you pay 2.5% on the loan to the lender, but I will pay you the difference between the 2.5% you paid and the 2.15% cap rate we had agreed. In other words, I'll pay you 0.35% or 35 basis points. So this gives you an example of where we might look to put swaps or caps in place, some sort of interest rate protection to help protect yourself against breaking a covenant.